Today, we're going to be looking at Disney stock to see where we believe it could go and how it's gotten to the point that it's gotten to right now, which is at $89 after the market will close today. First things first, I just want to say this is not any type of advice, right? This is not something that I'm recommending you go buy or sell for legal reasons. Again, this is just a complete analysis looking at the stock and saying, hey, this is what I think about it. Okay, so now that we're into that, let me go ahead and chop on some data here. The first thing that you'll see in Walt Disney is blue is that the Walt Disney stock reached its high on March 12th, 2021, and it reached a high of $197.16, which is actually a really remarkable number. And there's several key reasons why this happened, and these reasons coincide with why the stock has fallen. The first one was the hype over streaming, right? So everyone in 2016, 17, and 18 specifically, they were gearing up for the streaming wars, as a lot of people call them. And so what you'll see is stocks and other companies like Netflix and NBC Universal, Comcast, and even Hulu, which I believe is owned partially by Disney, they were all looking at ways to get ahead in the streaming game. And so there were two ways to do that. One way was by getting exclusive content that no one else had. For example, Star Wars for Disney or Harry Potter on Peacock, right? As long as you have that content in your library, you have the fans captive. There's no other place that they can go to get their favorite content, their favorite movies, their favorite series, so to speak. And then the second thing that set apart a lot of the streamers is what they were willing to carry. So, for example, Disney Plus, which is also known as Hotstar in India, they used to carry Premier League cricket. As a matter of fact, you can see right here in this story from The Guardian, which was published just a few months ago, they used to, again, carry cricket exclusively on their Hotstar Disney Plus platform. Well, guess what happened? As streaming continues to grow and as entertainment becomes more expensive for companies to continue to exclusively hold, these companies or these types of entertainment, such as the Indian Premier Cricket League, demand more money to be able to hold that content or put that content on Disney Plus, thus cutting into profitability. So Disney Plus decided that, hey, we have to somewhat make profit, but at the same time, we have to build our content in our library so we have consumers to eventually stranglehold into staying with us. So, as you can see, Indian Premier League on the screen, they decided not to renew with Disney Plus. They went to another company. And so what happened? Well, as you could see, they lost a whole bunch of subscribers, a net loss of 2.4 million from January to March in 2023. So that was obviously damaging, right? But not only that, uh, not only has that happened, right? But Disney also lost in this article, it points it out, 300,000 customers in the United States and in Canada, not because of content issues, so to speak, but because of subscription prices becoming ever more expensive to be able to host this content on their app. So because of that, the consumer is saying, hey, this is too expensive for what I get. The content isn't good enough for what I get. Or on the other side of this, they're just saying there is no content that I want here. I'm moving to another app. That's a big problem for Disney. We'll talk about that a little bit more later. But the next thing that we see here, which finally might rebound and might bring Disney back into the fray as a good stock to buy or hold or whatever, is the fact that Disney is finally making more revenue at their parks. So we know that Disney has always been expensive to visit, right? I know that, especially living around the Orlando area. Um, a lot of people will spend a lot of money to bring their family to Disney. But one of the things that happened in 2019 and 2020, if we go back to this chart right here, you'll see that the dip started happening somewhere right here in like November and December of 2021 and going into 2022. There's a reason for that, which is because of the fact that parks did not have revenue growth. They didn't even have positive revenue for some of that time. And the reason why is because of where these parks are located. So these parks are located in places like Shanghai and Paris and one in Anaheim, California, right? And so what you're seeing happen, or what you saw happen a couple of years ago, is that these places were limited legally by capacity, right? So the state of California or China, they really restricted movement amongst people because they were worried about the spread of COVID. And what happened was, well, Disney still had to pay nearly the same amount of employees that they had pre-pandemic, but they didn't have as many customers post pandemic, or during pandemic, right? During the heights of COVID. So what happened was they ended up taking losses on the amount of margin of profit they would make. And in some cases, with some parks specifically looking at internal data, losses overall. So that was something that wasn't good. And then as they finally do open back up and they finally do get back into the realm where, hey, everyone can visit Disney again, well, you had a massive problem on your hands. You had a political fight. And then they also had, in some ways, a legal fight, right? So, what happened was, there's a reason for all this. First of all, the governor of Florida, Ron DeSantis, decided to pass a bill, which I won't get into all of the details, but was controversial to many. Although I don't think it was necessarily controversial, it was, right, to a lot of people. And so what happened was Disney had to choose a side. They had to say, okay, well, as we're continuing to ramp up our business in Florida, we either have to support the governor and say, hey, he has the autonomy to act in his state because his state voted for him as an elected representative. So we're going to let him do his thing for his voters. Or they had the opportunity as a big corporation with a powerful voice to step in and say, we don't like this bill. Well, at first, they chose the first argument, which was, hey, we're not getting involved, which would have been profitable for business. But then what happened was, as they got pressured by a very select group within Disney, a more liberal leaning group who are not fans of Ron DeSantis, well, what happens? Suddenly, everyone looks and they say, well, at Disney, they say, well, we have to come out opposing this bill. And so what happens is they played politics and they ended up getting burned, right? Because there are two things that happened. First of all, they alienated half of their base, right? So we talk about, I use this example sometimes. Michael Jordan, the reason why he was asked, why doesn't he dive into politics a long, long time ago, many decades ago? And he said, I don't get into politics because Republicans need to buy shoes too. And that was shrewd business because what Michael Jordan saw is, hey, Republican, Democrat, black, white, Hispanic, whoever you are, you need to buy shoes. And if you need to buy shoes, there's always a chance to buy Jordans, which would help the company. So Disney did not do this. They did the exact opposite, and they alienated a large portion of their consumers, especially those in the Florida market. So, because of that, you look and you wonder, will they continue to have the full share of the market that they once did? Also, do they have the public trust? There's always kind of been this, I guess, nonverbal agreement that, hey, Disney is family friendly. You can enjoy your time in the parks. You can enjoy your time watching a movie at the movie theaters. You can enjoy playing Disney video games, right? You can enjoy all of these things because we're not going to push anything on you or your kids. We're going to let you be the parents. And then after that, we will teach some moral, great life lessons and stories ahead, right? So, anyways, they kind of breach that trust with a lot of consumers, which ultimately, again, if you think about this, a brand or branding overall is only as valuable as the consumers that buy into the branding. Take a look at Bud Light, what happened there. And then the last thing, this was written at the New York Post, and it was talking about the wokeism in movies. But I think that there's a bigger lesson here, and I'm just going to kind of read to you some of these numbers. Lightyear generated $226.4 million, but cost $200 million to produce. Let's check out another one. Strange World, which admittedly was definitely a film that at least half the country would not approve of, generated $28 million globally. and it lost $150 million. There's two things I take away from this. The first is that movie production is becoming more expensive, right? So as production costs continue to rise for unique content, for content that they're trying to push to an audience, what you're starting to realize is people aren't watching, just aren't watching their movies at the way that they would like to be profitable. So again, if you look at this, their margins go down. Even a huge one, and this was one of the movies going into the summer that I heard a lot of rave about. I heard that it was tastefully done. And again, controversy, it always seems to be there. But for the most part, right, I believe that if we see here, yeah, okay, so I read this, must have read this somewhere else. But basically, what happened was the movie Little Mermaid ended up making $500 million off of like a 200 or $250 million budget, which is good, but those margins aren't there for the amount of work and investment that they're putting in. Basically, what I'm trying to say is making a movie that is acceptable or bandwagoned by a large group of people costs a lot of money, and therefore it's risky that you could always lose your money instead of make it back or again, make profit. Just think about other movies like Avengers Endgame or two out of the three Star Wars trilogies in the sequel trilogy, right? Those were profitable. I believe all of them were profitable, but they made over $1 billion, right? And so when you're looking at, well, first of all, there's less people going to the movies. That kind of goes back into the public trust argument that I made. But then you take a deeper dive at that, and what you see is again the production cost, the risk doesn't equal the reward with movies, which scares investors away. So if you look and if you see this, this is a common cycle, right? I'm not necessarily trash talking Disney. As you can see here, within the last 5 years, they've maintained with their rivals at Netflix most of the way through, right? Both dropped at specific times that were similar because what they saw is that the cost to upkeep streaming it makes streaming less profitable than imagined a decade ago. And so as you see this, they kind of stay similar to each other, Netflix and Disney right here. And again, even if you pull out to the max view, this isn't the end of the world for Disney, right? A matter of fact, let me get rid of the comparison just to show you. Disney is still up massively from where it was, right? So even though it's down the last 5 years, if you go back to a year like 2014, well, where were they? $80, right? If you look down to 2010, where were they? $30. Do those figures keep up with inflation? Eh, maybe. So it might be worth actually less now than back in the day. But again, if you look at that, it's not the end of the world for Disney. But they have a lot of problems. They're slumping. They're known to be slumping. So now it's gonna take some masterful navigation from executives and the CEO Bob Iger to come back and to make this thing profitable. They've been through this before. We know that they can continue to grow, but the big takeaway, the number one takeaway I have for this video is that Disney can't just continue to buy up their competition. They're eventually going to have to change the trend. They're going to have to look at themselves and say, what do we stand for? What is our vision that we deliver on? And how can we get and make that monetizable, right? How can we make that profitable? Because again, if you keep in mind everything that's going on there, a lot of people have walked away from the brand. So, how do they extend that olive branch and say, hey, we're ready for you to come back and enjoy our brand? That's something that they're going to have to look at. And they can't, there is no other Star Wars for them to buy, right? There is no other Indiana Jones for them to exploit from Lucasfilms, or there's no other Marvel Studios that they could buy from 21st Century Fox or any of these. I mean, they really have a stranglehold on all of the mainstream content, and they're somehow still getting slapped around by Netflix, who doesn't have mainstream content quite the same way. But Netflix knows how to manage their assets to make the best possible series and docu-series out there. So we'll be interested to see what happens at Disney, but that is kind of a stock update for mid-July for Disney. I hope you guys enjoyed this video. Like I said, one more time for legal reasons. I'm not telling you to buy, sell, hold. I'm not telling you and giving you any financial advice, right? I'm not qualified for that. So don't take this as financial advice. Just take this as an overall overview to what is happening with this stock. So, with that being said, I hope that you guys have a great rest of your day. Thank you so much for watching Thinking Property. Have a good one.